Stop viewing Nvidia as desperate for cash. Recent headlines claiming that Nvidia raised $25 billion in debt might suggest financial troubles, but that misses a crucial signal in the bond market. The truth is that Nvidia's bond sale was oversubscribed by 3.4 times, with $85 billion in demand for just $25 billion. The last bond issuance by Nvidia occurred in June 2021, yielding $5 billion when the company generated $27 billion in annual revenue. Fast forward to today, and Nvidia boasts $216 billion in annual revenue. Even prominent investor Jim Cramer has speculated whether Nvidia is borrowing for company buybacks akin to Apple's strategy, as the stock was deemed too cheap. Recently, Nvidia announced an $80 billion buyback and raised its dividend from 1 cent to 25 cents per share. With $13.24 billion in cash and generating $49 billion in quarterly free cash flow, the question arises, why borrow at all? It's essential to understand Nvidia's strategy. Initially targeting $20 billion, the bond sale ultimately raised $25 billion due to overwhelming demand. The deal includes 7 tranches of notes with maturities ranging from 2 to 30 years, the longest notes maturing in 2056. The pricing was competitive, with the longest bond set approximately 0.65 percentage points above U.S. Treasury yields. By locking in long-term financing at current rates, Nvidia is demonstrating smart treasury management rather than financial desperation. The massive demand of $85 billion for just $25 billion means institutional investors, including pension funds and insurance companies, are eager to lend to Nvidia, viewing it as a strong investment opportunity. Moreover, the bond issuance caught many investors off guard, illustrating how sought after Nvidia's bonds are by the smartest money in the world. Another critical question arises: why borrow when Nvidia has sufficient cash? While they have $13.24 billion in cash equivalents and are enjoying significant cash flow, the primary motivation for this debt issuance is to create a liquid benchmark for their credit costs. This means they aim to establish publicly traded debt that will enable cheaper future borrowing, as the market will have a basis for pricing. Additionally, Jim Cramer's questions regarding a possible stock buyback program are more than just speculation. The newly announced $80 billion share repurchase plan and significant increase in dividends indicate a commitment to returning capital to shareholders, similar to Apple's financial practices. By borrowing at low rates to buy back shares, Nvidia is engaging in thoughtful financial engineering rather than acting out of desperation. The overall trend in big tech reveals a massive push towards AI-related spending, projected to escalate from $400 billion in 2025 to over $700 billion in 2026. Nvidia's position is unique. While they don't directly build data centers, they still need capital for chip development and manufacturing. In contrast to hyperscalers raising upwards of $70 billion, Nvidia's debt of $25 billion appears conservative, showcasing their cautious approach. To summarize the key takeaways from this discussion. First, the notion that debt is bad often traps retail investors. The overwhelming demand for Nvidia's bonds signals that institutional investors see tremendous opportunity in lending to Nvidia, not a warning sign. Second, Nvidia is mirroring the Apple playbook strategy of borrowing cheaply and returning capital to shareholders, which could positively influence their stock prices. Lastly, a bond offering helps establish a public benchmark for Nvidia's future borrowing costs, supporting intelligent planning for the next decade of AI growth. So, what's the best course of action moving forward? If you hold Nvidia stock, this bond offering should be seen as bullish, bolstered by strong demand and an approaching buyback. If you're a bond investor, Nvidia's investment-grade bonds with 7 tranches and low rates are worthy of consideration. For those tracking big tech, it's noteworthy that companies like Alphabet, Amazon, and Meta are all participating in this debt-fueled AI infrastructure push, with Nvidia at the forefront. However, keep an eye on interest rate changes, as rising rates may affect borrowing costs for all. Ultimately, the primary risk may not solely lie with Nvidia's debt but rather the collective debt burden across the tech industry. As spending slows, the implications of this collective borrowing may prove significant. What do you think? Is Nvidia's $25 billion bond sale a savvy strategic move or an indication that the AI boom is becoming overleveraged? Share your thoughts in the comments, and don't forget to subscribe for more insightful analysis on Nvidia and other major players in the evolving AI landscape.